us to think differently and enriching our personal beliefs. Today, we are proud to have Loretta Mester, President and Chief Executive Officer of the Federal Reserve Bank of Cleveland. Today's program is sponsored by the Gertrude F. Orr Donor Advised Fund of the Akron Community Foundation, Huntington Bank Advisor. Please refer to the brochures at your table for a listing of individuals and organizations who support the mission of Akron Roundtable. Thank Akron Roundtable Board of Directors for their dedication, and to our two staff members, Joan Lauk and Julianne Hansick, for their hard work and support. And would the board members please stand so we can acknowledge them? In the Akron Roundtable tradition, Dr. Mester was invited and has agreed to take questions following today's presentation. To submit a question during today's presentation, please refer to the brochures at your table or scan the QR code that conveniently is on the screen right at this minute to submit a question electronically. If you have questions but are without access to a mobile device, please use the note cards that you will find at your table. A member of the Akron Roundtable staff will be available to collect these cards during the Q&A session. For those of you on social media, please follow us at Akron Roundtable on Facebook, Twitter, and LinkedIn, and use hashtag Akron Roundtable to continue the conversation from today's lunch. Thank you, and enjoy your food. closest in. And Vivian, you can sit on the end.
And then can I come
And
down
then
that way?
you can come down that way, yeah.
Table minutes. But the table minutes.
Good afternoon again.
Oh.
In consideration of our speaker and your fellow members of the audience, please take a moment to silence your electronic devices. Akron Roundtable is brought to you today over radio station WKSU 89.7 FM from Quaker Station on the campus of the University of Akron. Today's luncheon is sponsored by the Gertrude F. Orr Donor Advised Fund of the Akron Community Foundation, Huntington Bank Advisor. Today, it is a pleasure to welcome to the Akron Roundtable stage Loretta Mester, President and Chief Executive Officer of the Federal Reserve Bank of Cleveland. Dr. Mester will be providing an update from the Federal Reserve. I now invite Vivian Hairston, Director of Portfolio Management, Huntington Private Bank, and former Akron Roundtable board member, to the podium to introduce our speaker.
Thank you, Kim. Good afternoon. I am so excited. As President and Chief Executive Officer of the Federal Reserve of Cleveland, Loretta J. Mester participates in the formulation of U.S. monetary policy and oversees more than 1,000 employees in Cleveland, Cincinnati, and Pittsburgh who conduct economic research, supervise banking institutions, and provide payment services to commercial banks and the U.S. government. She assumed her role as President and CEO in June of 2014. Dr. Mester was born in Baltimore, Maryland. She graduated with a degree in mathematics from Barnard College of Columbia University. She earned an MA and PhD degrees in economics from Princeton University, where she was a National Science Foundation Fellow. Prior to being named President and CEO of the Federal Reserve Bank of Cleveland, Dr. Mester was Executive Vice President and Director of Research at the Federal Reserve Bank of Philadelphia, where she served as Chief Policy Advisor, attending meetings of the Federal Open Market Committee, and oversaw economists and analysts in the research department, as well as professionals in the financial statistics department. She joined the Federal Reserve Bank of Philadelphia in 1985 as an economist, becoming Senior Vice President and Director of Research in 2000. Dr. Mester is an adjunct professor of finance at the Wharton School. She has also taught in the undergraduate finance and MBA programs at Wharton and in the PhD program in finance at New York University. Dr. Mester is a director of the Greater Cleveland Partnership, a trustee of the Cleveland Clinic, a trustee of the Musical Arts Association, and a director of the Council for Economic Education. She is a member of the American Economic Association and the American Finance Association, the Economic Society, and the Financial Management Association International. Please join me in welcoming Dr. Loretta Mester to the stage.
Well, thank you very much for that introduction, and thank you for inviting me to speak at the Akron Roundtable. I think it's a great opportunity for me. I'm going to talk about the economy and monetary policy, and I have to give a disclaimer that the views I present will be my own and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. So I just want to start by saying the Cleveland Roundtable's work to foster community dialogue aligns really well with the Federal Reserve Bank of Cleveland's own efforts to engage with the public. And I really like that word dialogue. So at the Cleveland Fed, we strive to provide our communities with useful research, data, and analysis. For example, we actually have a center that we've established, the Center for Inflation Research, and it provides various resources to policymakers, researchers, and the general public on inflation and its drivers. And as you can imagine, this has been a popular body of work and a popular website over the last couple of years. Now, in return, we receive economic reconnaissance from a wide variety of contacts from throughout our region. And I really believe that the Fed's engagement with the public leads us to make better policy decisions. And I also believe that the structure of the Federal Reserve System really supports that engagement. And so before I turn to the outlook for the economy and monetary policy, I'm going to give a brief overview of the Fed structure. And I always laugh at this because I'm thinking, like, I've been in the Fed for over 30 years and I'm still learning things about the Fed. So hopefully you'll learn something in this overview. So Congress established the Fed in 1913, and it was a period of financial instability, and the Fed was thought to be the institution that could help. And it really was established to promote the health of the U.S. economy and the financial system. Congress designed the Fed to operate in the public interest as what we call a decentralized central bank. So the Fed's independent within the government, but not independent from the government. And at the time, there were real concerns that the central bank would become dominated by financial interest in New York or political interest in Washington. So the Fed was designed to include representation from across the country and to balance public sector and private sector interest and Wall Street and Main Street concerns. So the Federal Reserve System has 12 regional reserve banks and a 7-member board of governors in Washington, D.C. that oversees the reserve banks. The governors on the board are appointed by the President of the United States and confirmed by the Senate. And then the 12 reserve banks are distributed around the country in locations that were the centers of economic activity back when the Fed was established. And that's why, if you look at the map today, it looks a little bit odd to have such a big territory out in the west and more reserve banks in the east, but that was because that's where activity was distributed at that time. Now, each reserve bank has a board of directors whose 9 members are chosen in a non-political process. 3 represent banks, and 6 directors represent business, agricultural, industrial, and public interests in the districts they serve. And one important responsibility of the non-bank directors on a reserve bank's board is selecting the bank's president, who is then subject to approval by the Fed's Board of Governors. Now, some of the reserve banks also have branches with 5 to 7 member boards. So the Cleveland Fed represents the Fed's 4th district, and that includes the state of Ohio and parts of Pennsylvania, Kentucky, and West Virginia. And we also have branches located in Cincinnati and Pittsburgh. And then, in addition, we at the Cleveland Fed have a number of advisory councils, again, that draw membership from various sectors of the economy and various parts of our district, so from different geographies. Now, I think that regional structure of the Federal Reserve System has served the country very well for more than 100 years since the establishment of the Fed. If you think about the U.S., it's a very diverse economy. It encompasses large cities, small towns and communities, rural areas, and there's a mix of different industries and occupations. Some places are more prosperous than others. So the Fed structure really helps to ensure that a variety of information from all sectors of the economy and all parts of the country is taken into account in our monetary policy decisions. And the Cleveland Fed's continuously gathering information from a diverse group of business, consumer, community, and labor contracts throughout our district. And that information really helps me formulate my views on regional and national economies and monetary policy. And I bring that information with me to meetings of the Federal Open Market Committee. So the FOMC is the body within the Fed that's responsible for setting monetary policy. And of course, other reserve bank presidents from the reserve banks that are distributed across the country are doing the same thing. So the discussions at FOMC meetings contain a mosaic of economic information and analysis from all parts of our country. And that regional information, along with economic and financial data, analysis, and discussion, really helps the FOMC setting of national monetary policy in pursuit of the goals that Congress gave us for monetary policy, maximum employment, and price stability. So I'm actually very much looking forward to the Q&A part of this, because I'm going to hear from you what you're hearing in the economy or what's on your mind, so I really appreciate that. So what is the information that we've gathered so far tell us about the economy and what the implications for monetary policy are? So you didn't see it on the screen, but I titled my prepared remarks, Progress and Prudence. Okay, so that may sound like the title of a Jane Austen novel, but I really think it's a good characterization of where we are and what will be needed to ensure that the economy returns to price stability. So let's talk about progress. To see the progress, I think it's going to help to briefly review how the economy got to where it is today. So think back, right? The start of 2020, so before the pandemic, right? The US economy was on very solid footing. It was the 11th year of the expansion. Things looked quite good from the perspective of our monetary policy goals. The unemployment rate was at historically low levels. Employment growth was strong. Participation in the labor force was solid. And inflation was near the FOMC's longer run goal of 2%. The pandemic changed all that. The economy shut down in March 2020. Fiscal and monetary policymakers took aggressive actions to support households and businesses, ensuring that credit continued to flow, and to limit the lasting damage to the economy. Then when public health statistics began to improve in May 2020, many parts of the country began to relax some of their stay-at-home restrictions, and the economy began to reopen. Now, as that reopening progressed, it became very clear that shutting down an economy can happen much more swiftly than reopening one. Spending patterns had changed, people had left the workforce, and supply chains were disrupted. And these forces are still having an effect on the economy today. The economy expanded rapidly in 2021 as demand rebounded, but the strong demand was confronted with very constrained supply in both product markets and labor markets. The imbalances in demand and supply led to significant upward pressures on prices in an environment of very accommodative monetary and fiscal policy. So a sharp rise in inflation began in the spring of 2021. Now, Russia's war against Ukraine, which began in February of last year, led to sizable increases in food and commodity prices, also contributing to rising inflation. Now, high inflation makes it harder for people that make ends meet, and it also imposes longer run costs on the economy by affecting the decisions people make about getting an education or training for a new job, and the decisions that businesses make about R&D, about investing in plants and equipment. These types of investment in human and physical capital help determine our economy's pace of innovation and productivity growth and its potential growth rate. And so our longer run standard of living can be affected by high inflation. Now, the Fed is responsible for ensuring price stability. So in March of last year, in the wake of high and stubborn inflation, the Fed began significantly increasing its policy rate, the Fed funds rate. So the rate has moved up a cumulative 4.75 percentage points. And the target range of the Fed funds rate is now 4.75 to 5%. And we've also been allowing assets to run off of our balance sheet in a systematic way according to a plan that we announced last May. And that's also helping to firm up the stance of monetary policy. Now, the policy actions, those monetary policy actions aim to tighten financial conditions to moderate demand, which will then help to reduce price pressures and bring inflation down. So the good news is that progress is being made. Underlying demand remains resilient, but economic activity has begun to slow. Real GDP grew at a below trend pace of 1% last year, down from a very robust pace of 5.75% in 2021. The slowdown in activity is most clearly seen in the housing sector, which is very sensitive to interest rates, but also in manufacturing and business investment. Now, consumer spending, which makes up 70% of GDP, has been supported by strong household balance sheets and income growth, but it too is moderating. On the supply side of the economy, disruptions in supply chains have generally improved. So our contacts from the district tell us that bottlenecks have eased, and survey data indicate that delivery times have shortened. And that's really welcome news because price pressures can be alleviated both through further moderation in demand and further improvement in supply. Progress is also being made in rebalancing the labor market. Overall labor market conditions remain very strong. Payroll job gains averaged 345,000 per month over the first 3 months of this year, which was a pickup from the average monthly gain in the fourth quarter of last year. The unemployment rate remains a very low 3.5%, near where it's been for much of the past year. Now, these tight labor market conditions have made it challenging for businesses to attract and retain all the workers they need to meet demand for their products and services. But we are beginning to see some moderation. Employment growth has slowed over the past year, and firms report that it's somewhat easier to find workers now. In addition, the rate at which people are quitting their jobs is moving down, which is usually a sign of a moderating labor market. And on the supply side, there have been gains in prime age labor force participation. So progress is beginning to be made in rebalancing labor demand and supply. And as that continues, it should ease wage pressures, which have contributed to high inflation. Now, turning to inflation, the good news is that progress is being made here as well. In February, the year-over-year measures of both total PC inflation and core PC inflation were in the 4.5% to 5% range, and they had peaked last year in the 5.25% to 7% range. Similarly, CPI inflation is also down. Measured year over year, CPI inflation was 5% in March, which is down sharply from its peak of 9% last summer. And core CPI inflation is now about 5.5%, which is still down, but not as much, about 1 percentage point from its peak. Despite that progress, inflation is still too high, and it's proven to be quite stubborn. Some measures of underlying inflation, such as the median and trim mean PC inflation rates, have shown little improvement since their peaks. And the disaggregated data show that the stubbornness is due mainly in the prices of services. If you look at inflation in core PCE services excluding shelter, that has not improved. It tends to be sticky, it's correlated with wage inflation, and it's a much larger share of the overall PCE index than goods or housing, since consumers spend a larger share of their income on those services. So what are the implications for monetary policy? So we've moved interest rates up significantly over the past year, and it is yielding progress. Yet demand is still outpacing supply in both product and labor markets, and inflation remains too high. In order to put inflation on a sustained downward trajectory to 2%, I anticipate that monetary policy will need to move somewhat further into restrictive territory this year, with the Fed funds rate moving above 5%, and the real Fed funds rate staying in positive territory for some time. Now, precisely how much higher the Fed funds rate will need to go from here, and for how long policy will need to remain restrictive, will depend on economic and financial developments. Now, with tighter financial conditions, I expect that demand in product and labor markets will continue to moderate, and inflation will continue to move down. Output growth will likely be well below trend this year and pick up a bit next year. I expect that employment growth will continue to slow, and the unemployment rate, which is very low now, will begin to rise to about 4.5% to 4.75% by the end of the year. And I expect to see meaningful improvement in inflation this year, with inflation moving down to about 3.75% by the end of the year, continuing to improve next year, and reaching our 2% goal in 2025. So what about Ohio? I do think we'll see similar trends here. Ohio is the 7th largest economy in the nation in terms of real gross state product. And when you think about the path of a regional economy, it really reflects the industry mix in that regional economy and the nature of the shocks that hit the broader U.S. economy. Now, manufacturing and within manufacturing, auto and auto parts still constitute an important sector of the Ohio economy. Compared to the nation, manufacturing represents a larger share of payroll jobs in Ohio, but that differential has fallen over time. Ohio's economy has been transitioning from one that's largely dependent on manufacturing and heavy industry to one that's diversifying into healthcare and education. If you look back in the 1990s, manufacturing represented about 20% of Ohio's jobs, and eds and meds represented about 12%. Those shares have now nearly reversed. In the past decade, the share of jobs in manufacturing has fallen to under 13%, and the share in eds and meds has risen to nearly 17%. And regions that have diversified their industrial base have generally fared better over time. And in general, since the pandemic, the economy in Ohio has performed similarly to the national economy. Employers have struggled to find workers throughout the post-pandemic expansion, and since workforce growth is slower in Ohio than in the nation because of slower population growth, it's been quite a challenging period for our employers. Rising inflation has also plagued businesses and households here too, but as is true in the nation, progress is being made. Employers tell us they're finding it a bit easier to hire and retain workers now, and their input costs are beginning to moderate. Of course, I think we all recognize that there's heightened uncertainty around the economic outlook. We've come a long way in tightening monetary policy, and some of those effects have not yet been felt in the economy. So in such an environment, a policymaker has to be very prudent in collecting and assessing the whole panoply of incoming information. So not only official government statistics, but also that regional information that we gather from our business, labor market, community contacts that I talked about earlier. We do a variety of surveys on economic and banking conditions, and then we look at higher frequency data, such as credit card spending, to give us a good gauge. And all that information helps us to determine not only where the economy has been, but importantly, where it's going. And of course, that's important because monetary policy affects the economy with a lag. Now, as we gather and assess this information, I'm prepared to change my views on the economy and appropriate monetary policy as warranted with changes in conditions. Now, one of the developments I'm going to be particularly looking at, and have already been particularly looking at for quite a while, is lending conditions. So the U.S. banking system is sound and resilient. But in March, stresses emerged in a small number of banks, and Silicon Valley Bank and Signature Bank failed. The Fed, the Treasury, and the FDIC took swift action to ensure that those stresses did not spill over to the rest of the U.S. banking system and financial system. Now, had such contagion occurred, it could have undermined the public's confidence in healthy banks and prevented them from doing their important work to support the savings and credit needs of households and businesses. Banks now have access to liquidity through a new Fed lending facility, as well as the traditional discount window, where they can borrow against sound collateral to ensure that they have sufficient liquidity to serve their customers. Now, the stresses experienced in the banking industry in March have eased, but the Fed is prepared to take further steps as necessary to ensure financial stability. And in addition, Chair Powell has directed the Federal Reserve Board's Vice Chair of Supervision, Michael Barr, to conduct an internal review and to report by May 1 on Silicon Valley Bank's failure, including the Federal Reserve's supervision and regulation of that bank. Now, even before those recent stresses, as interest rates have moved up, banks had begun to tighten their credit standards, making credit less available. And that's the typical way in which monetary policy tightening transmits to the broader economy. Now, the recent tensions in the banking system could well result in banks tightening their credit standards even more. which could result in slower spending by households and businesses and a pullback in hiring. And this would work in the same direction as tighter monetary policy. So we're going to need to continue to assess the magnitude and duration of those effects on credit conditions to help us calibrate the appropriate path of monetary policy going forward. That's the prudent thing to be doing. So in conclusion, there's been significant tightening of monetary policy over the past year. And as a result, welcome progress is being made in bringing demand into better balance with supply in product and labor markets and reducing inflation. This is good news, but inflation remains too high. Now, given that some of the increases in rates and tightening in financial conditions have yet to be felt in the economy, we need to be prudent in assessing all the incoming economic and financial information when determining the appropriate path of monetary policy going forward. We are much closer to the end of the tightening journey than the beginning, and how much further tightening is needed will depend on economic and financial developments and progress on our monetary policy goals. That said, price stability is critical for the long-run health of the labor market, the overall economy, and the stability of the financial system. So it would be a mistake to declare victory before the job is done. And here I'm reminded of the words of former Fed Chair Paul Volcker when he fought inflation in the 1980s. Chair Volcker said, "Failure to carry through now in the fight on inflation will only make any subsequent effort more difficult at much greater risk to the economy." Thank you.
Dr. Mester, thank you so much for being here and for helping us to understand the changes in the economic and financial realm. Our speaker, as I said before, has graciously agreed to respond to questions, and fellow Akron Roundtable board member Ed Markey will moderate the Q&A. If you have note cards, please hold them up.
Thank you, Pam, and thank you for your willingness to take questions. Point of clarification, the questions have been coming in digitally, and I've been taking a look at them while I'm sitting here. That's the reason I have my phone on my lap, as far as you know. Dr. Mester, has the Fed considered pausing interest rate hikes to determine how the previous hikes will impact the economy, and would it make sense to focus efforts on reducing the balance sheet?
So of course, as we've been raising interest rates, and we do this all the time leading up to FOMC meetings and in the meetings, we're always assessing what the stance of monetary policy is and whether it's sufficiently restrictive to get us back to 2% inflation and to make sure that we get a sustainable maximum employment, which are two monetary policy goals. So as we've gotten closer and we've seen some progress, we're always debating that kind of decision about, you know, how much farther to go and how much less farther to go. So my own view is that, you know, we've come a long way, and we're much closer to the end than the beginning, and we're going to have a meeting in 2 weeks or so where we're going to basically be talking about what the next decision was be. And that's part of what we're doing in FOMC meetings, is really determining whether we want to do that. In terms of the balance sheet, you know, by allowing assets to run off the balance sheet, that also, right, is tightening credit financial conditions. And so we're seeing the effects of both the tightening of the Fed funds rate, the increase in interest rates, and that reduction in the balance sheet on the economy. And that's also figures into our policy goals. But our active tool is the Fed funds rate, that policy rate. We set in motion last year that reduction in the balance sheet according to a plan, and we're continuing to follow that plan. And as assets run off, of course, the balance sheet is reduced and we get that tightening effect. But that isn't really the active tool. We're having that run sort of in the background, and then using our policy tool as the tool, active tool of monetary policy.
Thank you. We have a lot of questions, very, very, very thoughtful questions as well. We won't be able to get to them all. We'll get to as many as we can. You talked about this recent stress on the banking industry. Do you believe the Fed will be more accommodating of bank mergers allowing bigger, stronger banks to grow?
So I'll separate out the bank stress from the way we manage the merger and acquisitions. I mean, that we have a whole process that takes into account concentration of the banking and the regional aspect of banking. And that's a process that has some limits on sort of how concentrated the industry should be. The stresses that arose were really a classic bank run, if you will, right? Depositors withdrew money. Silicon Valley Bank found themselves having to sell assets at a loss, and that continued to then spook other depositors, and then they withdrew. So that's what caused that. We're prepared to take actions as necessary to make sure that the overall financial system remains stable. The new lending facility that we set up, which is a 13-3 facility under exigent circumstances, with a backstop from the Treasury, and the combination of that and discount window lending, right, has eased some of that stress, because we're basically allowing banks to borrow on very sound collateral, right? It's treasuries and agency securities, and that collateral is posted, and then they can borrow from the Fed, and that has calmed things down. So, the stresses that arose were in a few banks. The potential of contagion was what drove the actions on the part of the Fed to set up the new facility, and we're continuing to monitor what actions will be necessary, or not what actions, but we're continuing to monitoring the credit conditions and the credit standards that banks are now evaluating. We already had seen some tightening in those credit standards because of interest rate increases, and now we're assessing whether the stresses in the banking industry have increased the desire of banks to look at their portfolios and tighten credit standards even more than they would have without the bank stress. And that's what figures into assessing what the next steps on monetary policy will be.
Thank you. We have several questions around the theme of the US dollar. So what level of concern do you have about the US dollar losing its singular position as the global reserve currency, and what defensive efforts are being taken to preserve the US dollar as the global reserve currency? In addition, any other thoughts you might care to share regarding the US dollar vis-a-vis foreign currencies?
So, of course, the Fed, is not the entity that is in charge of the U.S. dollar. That, of course, the Treasury is the entity that really has concern for, or has the purview for looking after the dollar. The U.S. dollar, the value of the dollar does feed into monetary policy considerations because it's one of those financial conditions. But we take it as a given, and then we think about financial conditions. I mean, I think in general, right, the U.S. dollar is still the reserve currency of the world. And while it's very good to be thinking longer term of some of these issues, especially in a world of digitalization and other things going on, I don't think that's not my concern, high level concern right now, because maybe because I'm taking the Fed, the monetary policy perspective as a policymaker. My concern now is that we get back to price stability and continue to have a very strong economy here, and that can do a lot, I think, to continue our predominant role as a global economy, and that's where I'm kind of focused right now.
As long as you brought up digitalization, any thoughts you have on non-traditional currencies and the impact they may have going forward?
Well, it's certainly some things, things that are happening now in terms of technological advances have allowed some of the currencies to come on board. A lot of those are not really payments methods, right? So the Fed has a role in payments, of course, as you know. And in fact, we're going to be launching in July a new payment service, FedNow, which is an instant payment service. And I think sometimes there's confusion between what the Fed is doing in that space and digital currencies. Those are two separate things. And as Chair Powell has said, there's no move at the Fed to do a central bank digital currency. That would have to come from Congress telling the Fed that that's the direction they want us to go in, and that has not happened yet. So again, they're separate things. Right now, I think that the offerings of the Fed in payments are, the ones that are the traditional ones are very good in terms of payments. And then, if you think about cryptocurrencies and other currencies, I think of them more as, not a payments method, although a new asset that people can hold.
The headlines today and over recent days concern the debt ceiling. And we'd like to hear your perspective on Congress's decision to either raise the debt ceiling or failure to do so, and the effect that may have on the economy.
This is something that needs to be taken care of. If it's not taken care of, it will stress our economy, our financial markets. It's got to get done, and I think it will.
One of our audience members heard you speaking of hearing from business owners and other community and bureaucratic leaders. How often does your office hear from and take action based on community feedback from everyday people?
So we actually pride ourselves on talking to a broad spectrum of people in our district. It's something that we've worked hard on. And a way to kind of demonstrate that is if you look at the Beige Book, which is the book that we put out, the whole Federal Reserve System puts out a couple of weeks before an FOMC meeting, what you'll see is a new section that many of the reserve banks, and I'm proud that Cleveland is putting it in, called Community Views. And that is, our community development division within our bank has been instrumental in getting those views. And that includes views from individuals who we've contacted, but also a lot of the community development organizations within our district who are very much in touch with some of the challenges in low and moderate income areas and neighborhoods. And that does influence kind of how we look at how is the economy doing and how is it faring. And we really are aiming to have an economy that works for everybody, and that's a strong U.S. economy in all neighborhoods, in all places, and for all people. And that's kind of the goal that we're striving for. And of course, with monetary policy, it's measured by price stability and maximum employment.
Something else we've been reading and hearing about is the concept of a soft landing versus a hard landing coming out of a recession and interest rate increases. Could you walk us through that a little bit, explain the concept of the landings and what we can expect?
I think there's concern about, when you think about a hard landing, what does that mean, right? I think the concern is about we will have a recession and that we will see sharp rises in unemployment and people losing their jobs. Okay, that would be a hard landing, and perhaps some more instability in the financial markets and assets values going down. The soft landing, of course, is what we're aiming for, which is we get inflation on a sustainable downward path to 2%. And I like to explain to people that doesn't mean we keep raising interest rates until inflation gets back to 2%. Right? Because we know that our policy actions, affect the economy. It takes time for them to feed through. But we do need to get to a point where we're convinced that inflation is moving back down to 2%. In this environment, right, I do think we're going to have very slow growth, right? I think growth will be, below 1%, which is what we had last year. And that, right, is part of that readjusting of balancing supply and demand. When you're in such a low growth, it doesn't take much of a shock. Think of anything that we're not incorporating to send growth below zero, right? But the economy has been very resilient, and the labor market has been very strong. So my anticipation would be, even if that were to happen, it wouldn't be a sharp downturn, which is the hard landing, and that we will get inflation meaningfully down this year and continue to fall over the next couple of years. We probably will see some rise in the unemployment rate, but it's very, very low now and unsustainably low when you think about where we need to get back to have that healthy balance in the economy.
One of the other effects of the pandemic related to more folks working from home than ever. A following effect of that was a lot of commercial real estate now being largely vacant. How do banks respond to this type of a situation where commercial construction still going on? Are existing commercial buildings now being repurposed? How do banks look at that relative to helping fund new development?
So you're right. I mean, we have seen sort of the structural change, right? I would think that COVID and reaction to working at home is like a big structural change. At the same time, we have rising interest rates. Both of those factors, of course, affect the real estate industry quite a bit. And what you have seen is banks really looking at their portfolios, right? Some of those, loans are going to reprice over the next several years, right? And with rising interest rates, that'll matter in terms of the value of those assets. So banks are very much looking at their real estate portfolios, and rebalancing those portfolios and making sure they have enough capital and liquidity because of what the future holds for some of those assets. But on the other hand, if you look at housing, there's a structural deficit in terms of the supply of housing. And so if you think about multifamily housing as another, asset class in terms of real estate, right there, you would have thought with the rise in interest rates we've seen so far, you'd have house prices coming down quite a bit. That hasn't happened because supply is constrained. So again, there are multiple factors that feed into the pricing of those assets, which then feed into how banks will respond to those. And we have seen in our region banks reassessing, how much they want to have their portfolio in commercial real estate going forward, given the interest rate environment and given the other trends that you're talking about.
The individual experience we have at banks now is much different than it used to be, which kind of prompts this question. Do you think the efficiencies gained from banks utilizing AI technologies could potentially help stabilize the economy? And additionally, what potential risks do you see associated with artificial intelligence?
Okay, so I believe in technology. I am a positive on technology, and I think AI is already being used in several areas, and I see great potential in AI. But with all technology, you have to know how to use it. And I think that's something that we have to think hard about. Any institution that's implementing some technology, you better learn how to use it before you implement and know what the benefits are and what some of the caveats are that you'd have to be aware of. So again, I see that it has great potential, but I also think we have to really understand what we're implementing when we're implementing a new technology. And that's true of AI and all new technology. I think sometimes we forget that it's not just having the technology, it's also being able to utilize it in the most productive and effective way possible.
Thank you. We have time for about 2 more questions. Janet Yellen is on record saying that depositors at national banks big enough to be systematically important to the national financial system will be made whole. But what about local regional banks in Ohio?
Okay, so we have a deposit insurance system, and of course, if you're below the $250,000 in your account, right, your deposit is safe. It's backed by that deposit insurance system. What happened when Silicon Valley Bank failed was it was deemed to be a systemically important potentially exigent circumstance that it could contain. And that's why the actions were taken by the FDIC, the Treasury, and the Fed to try to make sure that there wasn't contagion there. going forward, right, and my understanding, of course, is that the FDIC is going to assess the banks to pay for that action. Going forward, I don't speak for the Treasury, but, we're going to make sure that I think what we need to aim for is an equitable, financially stable financial system, banking system, and so policymakers who are in the FDIC and the Treasury will make decisions about, what the right thing to do is. But we need a system that basically prevents us from having to take those actions, right? And so that, my goal always is, let's make sure that we're making the right decisions and having the right framework. And that includes not only regulation, but the rules to implement the banking regulations and also the supervision of institutions so that we can prevent ourselves from getting into a situation where hard decisions have to be made that then have repercussions going forward. And so by doing that, we have a much more stable banking and financial system, right? And then that also is beneficial for us when we're doing monetary policy because we can then focus monetary policy on the goals that Congress gave us. And we can focus our prudential and micro-prudential regulations and supervision of financial institutions to ensure that the financial institution stay stable.
I think you spoke earlier about reduction of population in the Cleveland area, affecting the workforce, et cetera. What's the economic condition of the Cleveland district in general, and what's the condition in relation to other Fed districts in the national landscape?
I mean, in terms of the population, we are getting some population growth in portions of our district. Columbus is doing better than Cleveland. Cleveland's losing population, Columbus is gaining. Cincinnati, last time I looked at, is stable. So, but that's important because workforce is driven by population growth is a really important component of that. And, as you get more jobs, with a labor market that, or a job, when the economy picks up, you want to be able to have a well-trained labor force ready to take on those jobs. It makes everyone better, right? The people who can get those jobs end up being better off, their families get to be better off. So that's kind of what we're aiming for. Other parts of the country, of course, are gaining population, the South in particular, and the West, right? They've gained a lot of population, and Texas is gaining population, and they have stronger economies as a result because they have more people that can go to work. So again, I think the reason population growth is important is because it feeds into labor force growth, which then feeds into productivity and just a healthier economy. And that's something we're going to have to address because if we want to keep growing jobs, which I think we all do, right, and grow the economy, we're going to have to be able to have, people to take those jobs. And that doesn't just necessarily mean bringing people in from outside, but also training, better training and education so that people are well equipped to take on not the job today, but the job of the future, because we know the economy is very dynamic and changing all the time. We want people to be able to understand what their work is today, but also to have the capability, right, to take on jobs of the future.
And to finish on an uplifting note with our last question, what sectors of the economy do you see as still being strong or growing even in such challenging conditions?
Well, the parts of the economy that are in the service sector, so personal and professional services, business services, they've been strong, which is also why inflation in those parts of the economy have been strong. The parts that are not strong, but they're still, it's pretty amazing that we've been through so much and the economy is just a resilient economy. The US economy is incredibly resilient. Think about back, when we first had COVID hit. Just think about how dire some of the predictions were about how we would fare. I mean, it was an incredibly dire period. There was uncertainty everywhere. And yet, we were able to get to the point where we are now. And things didn't get as bad. Now, a lot of actions were taken to prevent the bad, right? So we mitigated the downside. But even when we were taking those actions, it wasn't clear that that would be enough. So that just tells you that the underlying economy of the U.S. economy is an economy that's worth keeping, right? We have great things going on in the economy in terms of its resilience and strength, We do have problems. I'm not trying to undermine the problems, but I think it's easy to focus on the problems and not to really understand that we have, a good economy. We have, more jobs than we've had. We have a very strong labor market, and now we're going to do what it takes to get us to that soft landing that you mentioned before.
Dr. Mester, thank you so much for being with us today. On behalf of the Akron Roundtable, it's my pleasure to present to you A Contemplative Sun. This work of art was designed exclusively for Akron Roundtable by Akron artist Don Drum. Today's program will be broadcast on Thursday, April 27th at 8 p.m. on WKSU 89.7 FM. You may also listen to Akron Roundtable programs on our website or on our podcast channel. Thank you to the University of Akron and its Excel Center for Experiential Learning for sponsoring our podcast series. Please mark your calendars now for May 18th, 2023, for our next speaker, Cindy Hole, Treasurer of the Freedom to Read Foundation and newly elected President of the American Library Association, for her presentation, Ohio Unbanned, Librarians Protect Your Rights to Read and View Against Censorship. Thank you for being with us today, and we look forward to seeing you next month. Have a great day.
Thank you so much for your generosity with all those questions.
Yes.
The moderation is very good. Good moderation.
He did a great job.
Yes, please.